Most investors still think Coreweave and Nebius are the same kind of business. They're not, and the latest earnings report just proved it. Both stocks dropped after earnings. That's not normal. These are supposed to be AI infrastructure leaders in the middle of a gold rush, but the market smelled something and it sold off fast. Coreweave has a $55 billion backlog. They landed OpenAI, Meta, and NVIDIA, and the stock still dropped 16% the day after earnings. That's not a reaction to good news. That's a red flag. Nebius crushed revenue, landed a $3 billion Meta deal, profitable, and still sold off. That's not rational selling. That's fear. And when investors are scared after a beat, it means the story isn't adding up. So the question is simple. What did Wall Street see that retail missed? Because right now there's a gap between what these companies are saying and what the numbers actually show. And if you don't know the difference, you're walking blind into a market that's actively punishing hype. This isn't about what could happen. This is about what's actually happening right now inside two of the most hyped names in AI infrastructure. And if you're holding either of these tickers without knowing the truth behind that earnings drop, then you're gambling, not investing. This is Coreweave versus Nebius, and after this quarter, the gap just got wider. Investors keep treating Coreweave and Nebius like they're clones. Same space, same outcome. That assumption is killing portfolios. Coreweave is focused. They do one thing, rent out high-end GPUs to power AI. No side projects, no distractions, just deliver compute at scale. It's a single-lane bet on becoming the infrastructure layer for the world's biggest AI names. Nebius is built differently. They're building out the full stack. Compute, software, orchestration, deployment. Plus, they're running internal verticals like AV Ride for autonomous vehicles and 1010 for EdTech. They aren't just running GPUs, they're building the system those GPUs run on. That difference changes everything, because when supply tightens or demand shifts, Coreweave's path narrows fast. There's no fallback. Nebius, on the other hand, can reprice, repackage, and cross-sell. One sells raw speed, the other sells control. You're not looking at two versions of the same story. You're looking at two business models with entirely different risk profiles. The bottom line, Coreweave plays one game and they play it hard. Nebius spreads the field and builds leverage. They're not the same, not even close. The growth illusion. Who's burning more for less? On the surface, both of these companies are growing fast, but when you peel back the top line, the story flips. Coreweave posted $1.36 billion in revenue this quarter. That's a 134% increase year over year. But they didn't just lose money. They bled. Over $110 million gone in one quarter. And that's not including the CapEx wave still coming. Nebius came in smaller, $146 million in revenue, but up 355% year over year. Sounds impressive until you see the net loss, $119 million. And they diluted shareholders through an active ATM program. That's not discipline, that's plugging leaks. Here's the truth. Both companies are scaling, neither is self-sustaining, but only one is trying to grow with any sense of efficiency. Coreweave is flooding the engine with fuel. Nebius is turning knobs and watching margins. One is pushing speed, the other is studying the machine. That gap matters because revenue growth looks good in a headline, but cash flow tells you whether that growth can keep going. The bottom line, you can grow fast and still be fragile. That's what we're seeing here. Both names are chasing size, only one is chasing sustainability. The margins don't lie. One of these companies is getting leaner. Revenue is loud, margins are honest. Coreweave grew the top line, no doubt about that, but their gross margin collapsed to 2%. That's a rounding error. A few quarters ago, they were running at 20%. That drop isn't a dip, it's a warning shot. At the same time, Nebius reported gross margins over 70%, and unlike Coreweave, those margins are trending in the right direction. Cost of revenue is falling, efficiency is improving. That's how you scale without drowning. Capital expenditures tell the rest of the story. Coreweave is still in build mode, pushing billions into hardware. Burn rate is rising. Nebius is starting to stabilize. Their losses are smaller, their leverage is increasing. It doesn't mean they're safe, but it means they're shifting into a different gear. Here's the split. Coreweave is still buying speed with spending. Nebius is now buying time with discipline. That shift matters more than most people think, because speed without margin is just velocity toward a wall. The bottom line, one of these companies is proving it can scale without setting the house on fire, and the numbers are backing that up. Contracts, scale, and the moat that matters. A contract tells you someone wants your product. A moat tells you they can't leave it. Coreweave landed $55.6 billion in total contracted backlog. That number turns heads, and rightfully so. When you lock in names like OpenAI, Microsoft, and Meta, you earn credibility. That kind of scale isn't fake. But here's the blind spot. Those contracts don't make you irreplaceable. Right now, Coreweave is selling access to GPUs. That's it. Same chips other clouds have. No proprietary software, no orchestration layer, no lock-in. If a better price shows up, the customer can move. That's not a moat. That's a margin risk. Now, look at Nebius. Smaller contracts, less scale, but they just landed a $3 billion deal with Meta, and that contract includes platform support, custom model deployment, and their token factory stack. That matters because once a customer builds on that stack, switching isn't easy. That's product stickiness. Nebius is creating gravity. Coreweave is generating volume. This isn't about who signed more deals. This is about who made themselves harder to leave. The bottom line, Coreweave has the backlog, Nebius has the bind. One has scale, the other has traction, and traction is what moats are made of. Both stocks dropped after earnings. That wasn't noise, that was a message. Coreweave reported strong revenue, $1.36 billion, huge backlog, but the stock fell 16% the next day. That's not just volatility, that's disbelief. Investors saw the numbers and still pulled out, which means something under the surface didn't sit right. Nebius had a beat, revenue up, margins up, even landed a new contract with Meta, still sold off. Not as bad as Coreweave, but enough to show the market isn't buying the story without proof. This is what people miss. Retail follows the headlines. Institutions follow durability. They're not chasing the story. They're studying the numbers. Balance sheet, CapEx, margin trends, the stuff that doesn't show up in a press release. And that's what this channel is built around. I've got 3 business degrees, including a Master of Science in Information Management. I've also owned and scaled multiple 7-figure companies. I'm not looking at stocks like a speculator. I'm looking at them like an operator. That's why I break down earnings reports the way I do. Not to recap the news, but to extract the truth. What's working, what's fragile, what breaks when the funding dries up. Long-term investors don't just buy tickers, we buy business models, and that means we need to understand how these companies make money, spend capital, protect margins, and survive bad quarters. That's what I care about. That's why I look deeper. The market sold off because investors didn't see durability, they didn't see clean leverage, and their right to hesitate. Coreweave lost more because it raised more questions. Margin collapse, CapEx spike, no visible progress on stickiness. Nebius had fewer red flags, but the valuation is still high and the cash burn needs to narrow fast. The bottom line, the drop wasn't panic, it was clarity. Growth gets rewarded early, execution is what keeps it, and right now both companies are being forced to prove it. Both of these stocks rode the AI disruption wave. Both had glossy revenue forecasts. Both made big promises. But here's the real test. Now they have to deliver. This is where growth stocks either become businesses or get exposed. You can sell the story for a while, but eventually you have to sell results. And that's where the real risk is. Growth stocks burn cash. They run hot, some break through. Most burn out. The market forgives a lot during the hype phase, but once you're expected to operate like a real company, the scoreboard changes. This quarter, both Coreweave and Nebius showed more red flags than the last quarter. That's not automatically bearish, that's just the reality of stepping into the big leagues. Margins get tight, customers get picky, investors get brutal. So the question is simple. Which one of these names is actually ready for that shift? Let's start with the Coreweave bull case. $55.6 billion in contracted backlog, deep partnerships with Microsoft, OpenAI, Meta. Revenue growth is massive, 134% year over year to $1.36 billion. Still early in build-out. If margins stabilize, earnings could explode. If they layer on a real platform, they become category defining. Now the Coreweave bear case. Gross margin collapsed from 20% to 2%. They burned over $100 million this quarter, with CapEx still rising. There's no software moat, just GPU rentals. Anyone with money can copy that. And the net income margin, negative 17.8%. The Sharpe ratio, negative 0.6. Poor reward for the risk. Now the Nebius bull case. Revenue up 355% year over year to $146 million. Gross margins up 70%. Cost control is real. They signed a $3 billion contract with Meta that includes sticky software, Core product shows early signs of margin leverage, Sharp ratio 2.8, very strong risk-adjusted profile. Now the Nebius bear case, not yet profitable on a net basis, posted a $119 million loss, diluted shares this quarter to raise cash, and the PE is sky high at 82. It's priced for perfection. The cash return on invested capital, negative 45.9%. Levered free cash flow margin, negative 859.9%. That's a flashing red light. Coreweave moves fast, but it's bleeding to keep that speed. Nebius is leaner, smarter, and building the right way, but it still has to prove it can scale without breaking. The bottom line, neither of these companies is a finished product, but Nebius is trending towards stability. Coreweave is still racing to outrun its own burn rate. Here's what it comes down to. Coreweave is fast, loud, everywhere, but they're bleeding to keep it going. They don't own the product, they rent it. And if pricing pressure hits or supply shifts, they're wide open. Nebius is quieter, tighter, they're building tools that customers rely on, not just access to hardware. It's early, but it's efficient, and it's starting to show real signs of strength. Both companies had a shot at the AI boom. One chased speed, the other built structure. If Coreweave gets margin discipline, they could still flip the script, but that's a big if tied to a short leash. Nebius, they're not trying to win headlines, they're trying to win the decade. The bottom line, I'm bullish on Nebius, I'm cautious on Coreweave, and I acknowledge Coreweave has the higher risk and the higher reward, but that reward only matters if they survive long enough to reach it. You can own one or both. Just know this, Nebius is stronger fundamentally today. And if you like Coreweave, just make sure you understand the risk, because if they pull it off, the upside could be massive. That's not a guarantee, that's execution. Let me ask you something. Who else is breaking down AI infrastructure like this, cutting through the press release, showing you the actual numbers, and calling out the red flags in real time? Who else is showing you what these companies are really building and how to trade the story, not the hype? Nobody. That's why I do it, because we're not here to chase headlines. We're here to build conviction, and it's not just me. Steven locked in a 93% win on Google. Sam Clemens sitting on over 266% on Apple with zero rush to close. These aren't lucky bets. These are tactical exits, mapped out in advance, built on momentum, not hope. This is the strategy, and it works. That's why my accounts are up over $2.7 million this year, sitting on a 77.9% return in one of the most volatile markets we've seen. Inside my Patreon, you get real-time trade alerts with full breakdowns, entries, exits, and the why behind every move. Daily market analysis, no fluff, just what matters. My exact momentum system for scaling seven-figure positions with discipline. It's $30 a month. Instead of blowing that on bullshit, put it towards something that actually sharpens your edge. If it doesn't 3x your investing discipline, cancel any time. No pressure, no excuses. You've watched long enough. You've seen the results. The only question is, are you ready to execute? Because the truth is simple. You can scroll or you can scale, but either way, don't say you weren't told.